Hi everyone, welcome to this webinar on why failures matter in strategy. This webinar comes off the backhand of a new publication that we have released recently at Quadrant Consulting by the same title. My name is Jonathan. I'm a consultant here at Quadrant. I'm a big strategy nerd and also a co-author of the paper. And today we are going to try and give you a little bit of a new perspective on strategy and some inspiration on how you can stack the odds of strategy success in your favor. Very briefly about Quadrant Consulting. We are a management consultancy. We are Copenhagen born, and we are razor focused on anything commercial and growth oriented. So that's in the domains of sales, marketing, digital, corporate and business unit strategy, as well as transactional services. Our approach is very senior-led in how we deliver, and we try and stay sharp also by writing quite a few publications and being at the forefront of the next generation of commercial transformation and growth. The agenda for today's webinar is we're going to start off with a little bit of an analogy to try and get the right perspective on strategy. Then we're going to take you through a little bit on what's the value of actually working with failures in strategy. That can sound a little bit negative, but we'll try and give it a positive spin. I'm going to give you an overview of the 32 sources of failure in strategy and a few case examples from the wild. And we're going to round off with a few practical actions that you can take for your next strategy cycle as well. So how do we view and approach strategy today? And maybe it's good to start off with a little bit of an image. So when you hear the word strategy, what's the first image or visual that kind of comes to mind? If I was a betting man, I would say it's probably something around chess. That's the visual that you see quite a lot over the internet, and analogies close to that in a lot of strategy books. And a little bit of a fun fact here, 4.5% of all the assets on Adobe that are tagged with strategy is actually around chess, and it's the single biggest category. So I think that visual of strategy is quite universal when it comes to chess. So why are we talking about this analogy? Well, leaders today have never been more well-read on strategy as they are right now. And that confidence shows. So 71% of executives, they feel well prepared for strategic risks in strategy development and execution. We'll get back to in just a little bit about why that is really important. So when it comes to this analogy, I actually think that chess is a really bad one, because chess is a game of equals. Everybody's working with perfect information, and you're really trying to outsmart one opponent. And nothing is left to chance or luck, because if you make a mistake that makes you lose the game, you can trace it back to a single source of failure, and you can avoid that in the future. I actually think that poker is a much better one, because you're working against multiple opponents, as we are in business, and they aren't always equal. Some come with more cash or resources to the game. Everybody has perfect information because we don't know what the other players' hands are. We can only see what we have ourselves and what's on the table. Even if you perfectly execute your strategy and plays and run the probabilities, you can still fail. And actually, chance and timing plays a big role in poker when you make the big bets and how you come off and even you can bluff. And a really important piece is that there are multiple points of failure. So you can't trace it back to a single thing and adjust your method and then be successful. I think that frame of mind around probabilities, knowing that you can fail, is a better analogy and mindset also to approach strategy with. So why does this even matter, this perspective and mindset? I think most have probably heard something around this fact of 70% of all strategies fail, and we can debate a lot the validity of that fact. But I think there's consensus around that there's a high probability that something in the strategy will fail. I think in reality, the truth is that you can be 100% sure that a component or parts of your strategy will fail. So knowing that, how can we actually reduce the probability that our failures won't destroy the overall success of the strategy, and that we don't overemphasize on the failing bits? I think that approach is much more sound. So let's dive into working with the strategy. And I think most strategy models, when they are somewhat simplified, they fall into these 4 phases. There's a problem formulation phase where you're trying to look at what's the burning commercial problem that our strategy needs to solve. And we have the strategy development, which there's a lot of literature around and a lot of emphasis on, where we're trying to ask, what are the key choices and priorities that we make in order to solve our problem? The next phase is planning. How do we actually turn our strategy and decisions into a plan that we can start working with and ticking off the boxes? And the last part is execution, which has the longest time horizon typically. And there we try and answer, how do we embed the strategy execution into our everyday and make sure that it's sustainable and impactful? Doing our research for the paper here, I think it was clear that there's a bit of an investment disconnect currently between where companies invest resources in order to make the strategy succeed and where they actually fail. So if you look to the 2 ends on problem formulation, we see quite a lot of the sources and reasons that strategy fail there, and also an execution which is taking more emphasis currently when in the discourse on strategy. Where companies invest the most in strategy development is typically also where executives and those that are developing the strategy are actually most comfortable working with. I think the second disconnect is that you can almost guess exactly how the strategy wheel looks like for most companies. And it goes something like this. There's the quarterly management update on the strategy, the quarterly or biannual board update on the strategy. And if something is really burning, you have an ad hoc course correction. And then at some point in the middle of the strategy cycle, you do an update. And when you get to the end of it, you do a revamp. So companies, they approach strategy very much as a process with fixed dates and cadences. And cadence is good. But the problem is that it's not a continuous practice that is need-based or necessarily ingrained into the everyday beat of the drum in the organization. And that's one of the reasons that strategy can sometimes feel a little bit like a song and dance, because you know when the next time you have to hit the floor and start the cycle over again. And the last disconnect I just want to emphasize here before diving into the sources is that there's also a little bit of an evaluation disconnect. It seems that working actively with where the failures are in strategy is really reserved to when we're doing the big update or revamp every couple of years. And when we are in the process of developing the strategy, but also executing on it, we're looking at how do we make this next part succeed? How do we make this next part succeed? And then at the end, we're looking back and saying, well, where were the mistakes and what do we need to course correct for the next 2 or 3 year period? A different mindset revolves around failure. That can seem negative, but actually the good thing about it is you're trying to work with probabilities and you are constantly also retrospective. So you're looking at how do we avoid failure in the next part of the process. And when we are at the next part of the process, actually going back and looking at, do we need to reconsider some of the choices or hypotheses that we had earlier? And then when you actually get to the evaluation, you don't need to identify where did we fail. You have a conversation about what failures should we actually have caught earlier or pivoted on in order to ingrain that into the next part of the strategy cycle. So working actively with failures continuously when you are building the strategy and executing it and evaluating it is, I think, a much more sound way of doing it, and also works much more around probabilities. And as we saw before, the probability of failure is very high, and that also helps you combat a little bit this maybe overconfidence in our ability to outsmart our opponents and build a winning strategy. So in summary, failure is the reality in strategy, and adopting this continuous mindset is a good start to help stack the odds in your favor. I think from these three disconnects, there are three imperatives. We need to invest more in the early and late stages of strategy. We need to make sure that strategy is a continuous practice in the firm that you're working at, and that it's really ingrained in the everyday. And then we also need to ensure that we look retrospectively throughout our strategy development. With these imperatives in mind, I think it's a good place to actually dive into the 32 sources of failure across each stage of this simplified strategy process. So what are the 32 sources of strategy failure? Well, here they are. Going through each of them in detail, that can take quite a long time, and more time than we have in this webinar here. And the text is also too small to read properly for you. So what we've done instead is we've tried to curate a little bit in each stage and dive into just a couple of them, but you can read much more in our paper. Also trying to put a little bit of structure on how we're going through each phase. So when we're looking at each phase, we'll try and answer, so what are the driving causes of the failures? What are some of the most common ones? And I'm just going to try and highlight two for each phase that I think is one of the most important ones or common ones. I'm going to give you a few stories from the wild. Some will be very recognizable, and others is from our client work, anonymized, of course. And for each phase, we're going to give a few mitigating actions in order to frame the conversations in the strategy development rooms. So problem formulation. I think a good strategy actually starts with a problem, and problem formulation starts with the same. There are some key characteristics of a strategy-worthy problem. It needs to have real negative effect on growth or profitability. It also should not be able to be solved by a single initiative or action or program. And it's also really important that the solution is not straightforward, and also the problem is not straightforward to define and actually box in. And the last thing is it should be a problem that's unique to your company, or at least context. If it's a universal problem, it's not strategy worthy. I think a good way of actually framing that conversation to start with, to see do we actually have a problem, is asking, why can't you just keep doing what you're doing today? Is our strategy today fundamentally broken? And if it's only a subset, maybe we just need to look at doing something specific to that subset. So why are good problems so important and problem formulation really impactful in strategy development? One of the big reasons is that a good problem actually leads to less ambiguous and much more clear winning ambitions, which is something that most of us have worked with in many different contexts, or a vision. So it's easier to frame an ambition or a vision up against the problem, and you naturally become much more specific about the content and the early decisions there. When you are in decision making and planning, it's much easier to make choices when you can constantly evaluate whether we are actually addressing the original problem we're trying to solve. In the overview here, you can see the 8 problem formulation sources of failure. I'm going to go through them relatively quickly, and then we're going to deep dive into 2 of them. So the first one is an unclear why. You've probably heard these vague kind of slogan-like problems. We need to be the leader in digital, or something akin to that. Another one is actually misidentifying customers and not fully understanding the pain points and also opportunities to grow with them. Poor market understanding, we also see a lot where you're building products for demand that's not in the market. And it's often because engineers have a really good idea, and that can still be true, but the demand is not there. Coming back to the confidence with executives, there's also a tendency to underestimate the capabilities of competitors. And the same also goes for ignoring the big tectonic shifts in the industry as well. I think an interesting one is that not having stakeholder buy-in, that you actually need a new strategy. So in order to work coherently in strategy development execution, those that are at the top of it, they need to agree that we need to do it, this is the problem, and actually mobilizing towards solving it. Second to last one is overestimating your own capabilities and skill sets and thinking that what you have today will naturally translate into the future. The last one is a term stolen from poker, again, pot commitments, which simply is overcommitting on a single or few alternatives without actually evaluating all the alternatives that are, and that can lead to some issues. Let's dive into an example of that. Don't know how many of you remember BlackBerry, but it used to be really big. And I think BlackBerry is a very recognizable example of this pot commitment issue. So even as consumers, they started embracing touchscreens and an app ecosystem, much more open source. The leadership at BlackBerry, they really clung to what they were winning with yesterday, which was a QWERTY keyboard, this enterprise email model. Not everybody knows this, but BlackBerry, they actually tried to move on and they accepted this sunk cost, but the market have moved on. You could also have Nokia as another relatable example to some of this as well. So what can you do to actually start working with better problems and ensuring that you actually are in need of a new strategy? I think the way to do it is actually to reframe the conversation to ensure that it's an actual problem that you're working with. So it's going from this sentiment around, it's time for us to get a new strategy, to actually asking this question that I mentioned before, why can't we just continue doing what we are doing today? And if the answer to that is not really multifaceted, that there's a lot of components, then you may not need a new strategy. You can roll on with what you have for a little while longer and focus on actually building a dedicated program to the area that you want to fix. The second thing is also trying to reframe a little bit and not look so much at the future in terms of where will growth and profit come from, but actually try and take this retrospective approach and some specific components. And some of these questions are some questions that have sparked really interesting conversations with clients that we've worked with. Like, for example, why is our core customer base eroding? That's a very different way of framing than how do we grow our customers. Actually looking at what's failing to try and pinpoint where the opportunities are. And you can do the same for other components in your commercial ecosystem around competitors, the market, or the industry. So that was it for problem formulation. Let's talk about strategy development, where most leaders are comfortable and feel like it's their wheelhouse. I think the big issue with strategy development is you actually need to engineer a vehicle that will solve your problem. And there's a lot of misengineering, over and under dimensioning that happens at this stage. And that can sometimes be from having an overly, we call it visioneering starting point, and then you have to include too much. In strategy development, it's all about choices. And choices are hard for regular people, but hard choices, they are even harder. I think the key here is that when you're making a choice, it leads to what we call a portfolio of changes. It's not a single thing, but multiple things that change, which will generate the impact that you are looking for in order to solve your problem. The issue is that if you try to include too much, the portfolio of changes gets too big, and you actually get a really watered down impact out in the end. And when we look at the sources of failure in this part here, they really mirror this image here. So the first one is not making actual choices. You can't do everything at once. And if you're trying to, then you're doing something wrong. You need to make a choice and deselect something. The second one is having unrealistic or vague goals, coming back to this anecdote of we want to be the leader in digital. But what does that actually mean for your industry and context? You have to be specific and set goals that you can measure against. The capability gap is a big one, not having the necessary things in order to drive the strategy home for those key parts of the strategy. Prioritization is actually something that you do in the strategy development, and if everything is in the top right corner and priority one, then nothing really is. A subtle one that we see creep up often is leadership misalignment. So in the strategy rooms or communicating to the organization, they seem to be in alignment, but behind the scenes, they are pulling in their own directions, and that's really detrimental in the strategy development phase. Adaptability is key. Also, when we look at failures, you have to be able to pivot, and oftentimes kind of the strategy path is really hard-coded in, and that makes experimentation really hard or pivots really costly, and can lead you to falling into pod commitments as well. Narrative and story is really important. So if you have a strong why for why you need to do a new strategy, you also need a good narrative and storyline that will take you from the strategy document, often in a PowerPoint, and try to bridging it into the real world. The last one is just doing insufficient analysis and not being able to test off those key hypotheses, and actually writing on experience and anecdotes and not evidence. And that can be a little bit of a dangerous path to go down. A few stories from the wild on these two specific sources. So the first one on no actual choices from a client of ours. For an IT services firm, we asked the leadership team to try and come up with a priority of the top 3 market for expansions, in their opinion. They ended up settling on a list of 10. And you've probably heard this phrase in some form or other, well, we're leaving money on the table if you don't also do this. I think the outcome is natural to stretched resources. The second one is it can be a little bit hard to kind of grasp the extent of around capability gaps. But one example is an industrial client of ours that was building their digital offering as so many companies do, from the allure of subscription or recurring revenue or service revenue dynamics. The issue was that they really underestimated the gap from that way of working and selling to the regular, very CapEx sales heavy organization. That meant they needed new infrastructure, contracting, data handling, and a lot of other capabilities. And I think that image specifically we've seen quite a few instances across multiple industries as well. What can you do tomorrow to try and mitigate some of this? I think there are 2 good litmus tests that come from these 2 very common sentiments that are meant in a very positive and aspirational way. Let's be ambitious and put it on the list as well. Aren't we ambitious? Well, if we can't clearly answer which choices as part of the strategy really hard to make, where we feel like we're giving up something or we're deselecting something, if those answers don't come immediately, you probably need to reevaluate your choices. And the second one is maybe very Nordic. Let's try and keep everybody happy. Let's try and give everybody something. Well, the reality in strategy is that you need to have some groups that you're upsetting a little bit and have a clear answer to why. If we're not asking significant change of them, then we're not being thorough enough in our strategy or demanding enough as part of our strategy. So temporary unhappiness, that can actually be a good thing in strategy. It should be part of it. Planning is a little fragile, actually, and I think a lot of executives, they underestimate the fragility of this part. And that's because it's where ambitions, they collide with the practical reality. If you look at the image over there on the right, you've probably seen something that looks like this. This is the typically overloaded plan. A lot of things are starting very early on in the strategy cycle, A lot of things, they stretch over a long time, and they have a long time until you see impact from the strategy in the strategy period. And that's actually a big problem. And the reasons for this plan actually materializing and the team thinks it's a good idea are these 8 sources here. The first one is maybe a little bit obvious. There are too many initiatives, so you spread the resources too thin. The second one is actually a little bit undervalued, I think. So no change support. What does that mean? Well, when we are building the strategy in the strategy development room, people have processed the strategy much more and have a clear picture of what it actually means. But when you're trying to move that over towards execution, and if you haven't had a clear translation, you can leave too much up to interpretation. So if you want to be the digital leader, what does that mean for IT, for finance, for marketing, for sales? If there are differing interpretations of what's important and what it actually means, you can get up into very different outputs here. Third one here, maybe a little also obvious, but we see time and time again, really unrealistic timelines. Some fixed dates because we want to show progress, but they're not founded in any reality in terms of our ability to deliver. Fragmented ownership is really interesting. A lot of initiatives, they are put on committees or cross-functional groups, but no actual single owner that is accountable. Missing involvement is a key part of that the functions that are asked to deliver on the unrealistic timeline, they are not actually at the table when you're making commitments about how fast things will happen and what will be delivered. Undefined success metrics, another way to phrase that is undefined failure metrics, where the teams working in the work streams, they don't have a clear image of what does success look like and what are the criteria for us to stop these initiatives. Too long time horizons we saw in the image earlier, where an initiative stretches over the entire strategy period. You're not seeing the impact in a reasonable time, and that means that you probably need to re-engineer that initiative. Talking about engineering, I think there's a tendency to go for perfect first, really over-engineering the first version of an initiative. It's much better to actually look at getting from the startup entrepreneurial world a good MVP and then build from there, so you can start seeing the impact early. You avoid the too long time horizons, and then you actually get the learnings, get it embedded, and you can start working with it. Few stories from the wild also here. Hopefully it's something that you can recognize. Another industrial company that we worked with for their initiatives, in practice they didn't have owners. So it meant that the committee, they ended up sending even small decisions or discussions up to the steerco. The steerco was made up of 3/4 of the executives. So a lot of the processing and development actually happened up in the steerco, making things go slower, and nobody was actually accountable for the outcome because you're only sitting together in big groups. You need that accountable owner. The second story here is again around digital, which there are a lot of investments going into still across firms. One organization that we worked with, they had dozens and dozens of digital initiatives and projects and tidbits as part of their strategy because they wanted to be a leader in their field, in that domain. The issue was that there were no real clear success metrics for each of the initiatives or from the strategy perspective. So when you were looking at the status presentations on progress, the statuses were really vague in terms of what had happened, what's the impact, and what are the next steps. So a couple of years later and a few millions later, they couldn't really tell whether all the efforts and resources they have poured in were actually worthwhile, and also which projects or sub-projects they should actually have killed as part of the process. They ended up completing everything, a bit to the detriment, because when you're allocating resources one place, you're taking it away from another place. So a few mitigating actions when you are in this phase in your strategy development. Have a good checklist, and here's a place to start. Small one is actually having a handful of quick wins early on, planned in, and making that a cognitive choice. Also making sure that you're not working with more than a quarter of the initiatives at any given time, so they're really allowed to be given focus and effort. Coming back to this ownership, making sure that there is a single name on the initiative and that they are also accountable. Making sure that you actually have initiatives planned in the future that you really wanted to start now, because then coming back to the choice source, then you're ensuring that we're actually making hard priorities. Simple one, just making sure that there are no initiatives that stretches across the full cycle. Making sure that we involve those that need to execute on the initiatives as part of the timelining and planning and the process development. And then making sure that we have really clear KPIs, but also kill switches for each of the initiatives. What needs to be true in order for us to stop this, and what needs to be true in order for us to deem this a success. Last part here on the sources of failure around execution. And when you get to this stage, the leadership team or the strategy developers are really facing a difficult mental perspective. There are two reasons for that. One, you can quickly assume that now we have the document, now change will start happening. We've articulated the strategy. I think one of the reasons for that is that those that are developing the strategy, they spend an increasing amount of effort on the strategy and really digesting and internalizing it. And once you get to the execution part, is typically where the strategy team, they celebrate. Now we've launched it. There's a big pump and circumstance. But the organization, they are on a different cadence. They're just starting to get a feel for the strategy, and they need to start the work of internalizing it, translating it to their reality, etc. I think that's really one of the key things in execution, because the executives and the strategy team, they have worked so much with the strategy, they over-index on assuming that others have the same depth and internalization of the strategy too fast. So how do we mitigate that, or what are some of the sources for that? The first one is poor communication, and it's something that's typically underinvested in and something that's put on marketing or the communications department as kind of a side task to their existing suite of tasks. So if the strategy frontline, they can't clearly explain to customers or the organizations the why and the how of the strategy, what's the problem we're trying to solve, what are the changes that we're making, how will it impact you, you're not communicating clearly enough. Back to accountability. So when we're looking at execution, owners of initiatives, if you have that, they can sometimes end up being kind of the status report compiler instead of actually having the mandate to make decisions. And if they don't have the mandate to come with recommendations or make decisions, they don't really have accountability. They are moving paper around. Resource shortfalls, which can oftentimes stem from the strategy development and planning phases, simply not having enough focused resources to actually complete the tasks at hand. Cultural resistance is a tricky one, where employees, they can take part in the pump and circumstance, but behind the scenes, they are quietly resisting the new practices and falling back into the old ways of working. Next one is this inadequate progress monitoring. Actually having the cockpit in place so you can monitor how the strategy is going, and having a good cadence on that is not necessarily quarter-based, but much more need-based, and where you can actually give very clear and crisp statuses on the initiatives where they aren't vague at all. Failure to adapt, again, also very much tied to some of the other sources, that If you ignore some of the early warning signs that an initiative is starting to go awry and you're not making adaptations, you are sticking to the plan, that can be a place where you overinvest resources without seeing the outcomes that you need to see. Integrating the strategy into the daily life is really important, but oftentimes strategy and the development of the business is something that we put on top of the day-to-day, and that again stretches resources too thin. The last one here I think is super important, coming back to the checklist in the planning phase, actually having early wins that you can celebrate to show momentum. If it takes too long until you can check off the first initiative or have something to celebrate, then you might take momentum away from the execution. The organization needs to see that doing these changes is having an impact and is positive for them as well. Rounding off here on the stories from the wild, a little bit of a positive note. Giving you an example of when it works really well, integrating the strategy into the daily life. An American conglomerate that I've worked with in one of the divisions, they had a strategic principle that was really, really ingrained in the strategy and even across multiple cycles. What was really interesting to see is that it permeated every single discussion that we had when we were making decisions together, and our recommendations were always held up against that principle. So when the strategy is clearly translated into that divisional context in this case, and making it ingrained into the daily life at really every level, from the managing director of the division down to the sellers, you can really see the impact of doing that well. So rounding off here on a little bit of a positive note. So what do you do in strategy execution in order to try and mitigate some of these sources of failure? I think a good place to start is actually building in what we call a failure learning loop. So it starts off with being able to detect, so you have the clear signals or KPIs that tells you when an initiative is a success or a failure, also talking to customers if they're not seeing the impact. Then you need to have a framework for how do we decide on, do we pivot to something else? Do we continue as is, believing that it will change, or do we actually kill the initiative? Then you need to reallocate those resources, and that sounds easier on paper than it actually is. That goes both on capital and money, internally with partners, internal talent also, and time. And the last one is also really key on attention. When you have that focused pool of initiatives that you're working with, actually swapping one out and putting a new one in will give it proportionally a lot of attention. And then coming back here to that communication piece, it's really key to also communicate during execution. And typically when executives, they get tired of communicating the strategy is when the organization actually is just starting to internalize it. So you need to be transparent about new decisions, the new actions, and the expected impact from stopping or moving forward with a new initiative as well. So trying to close down a little bit, giving you a few practical actions for your next strategy cycle before, during, and after. Before going into your next strategy cycle, I encourage you to do what we call a strategy audit. And this framework that you see here on the screen is something that we work with and even also offer to clients. And it's a good way to get a concrete and early feel for how is our strategy faring. And it moves through the different phases of strategy as well, and gives you a few indications on where do we have gaps and where do we need to spend more time in this next cycle. So the first question is, do you have a clear idea of what you want to achieve and why? And I think typically here you will get an answer, yes, of course we know that. But when you ask people in the organization a bit more unprompted, a lot of times we see that they can't give a clear answer. That means you need to clarify much more in terms of what you want to do. The second one is, do we actually have clear hypotheses about how our business and market and industry will evolve the coming years? And if we only have anecdotal examples or gut feelings, we need to spend time actually contextualizing and getting that clear image of how is the business and context faring. Next one is about trying to be really specific about what are the actions that we think will bring us ahead of the competition. And if we don't have a clear idea about that and how the competitors are faring, what bets they're making and why, and actually believing that their bets are smart ones, we need to analyze more. Then we need to look at, do we actually know kind of the sequence or the leading indicators of success for our actions? This comes back to the planning stage. If we can't give a clear recap of what's the plan now and the next chunks afterwards, we need to spend more time on planning in the next cycle. Then we get more towards the execution part and actually being able to answer, do our colleagues and even clients and partners see the advantage of this strategy? Do they believe in it? And can they explain the impact that they will get from it from the different perspectives of a colleague or an employee of the company, on the customer side and on the partner side as well? If we don't, we need to make sure that we communicate better in the next cycle. And the last one can sound like a little bit of a banality, but you'd be surprised about how much unclarity there is here, which is a simple question. Does everybody know what to do? And if you don't, you need to catalyze and make sure that you get your ducks in a row for the next cycle, so that everybody has clarity in terms of what's the next step in the plan that I need to start executing on. A little bit of a busy slide, but during your strategy, try and implement some of these questions and actions in the different phases, and trying to reframe the conversation, really challenging the reasons to do the strategy and look very much more retrospectively in terms of are the decisions we are making the right ones, and are we realistic also about what we intend to execute on. And then after your strategy, when you are in execution, you're looking at evaluation, it's really important that you stay aware of the different sources of failure and also the forces of failure. There are quite a few. We know the typical ones around working in silos, internal politics, or the short-termisms where you're chasing the next quarter and not actually developing the business, where running the business actually takes over. There are the human factors that you need to be aware of, and I think we've covered quite a few of them here in the webinar as part of the sources of failure. Really boiled down, it's around the resistance to change, not wanting to have sunk costs or pivoting from projects that are deemed a failure, and also the magnetism of big bets, coming back to this analogy of we want to be the leader in digital. That sounds magnetic, but what does it actually mean in your context? And of course, there's also a lot of factors from the outside on regulations that you need to be compliant to, technological disruptions that a lot of our clients, they are facing right now, and I'm sure that you are also feeling the impact of. And lastly, also how your competitors are moving in the poker game, and why they are placing the bets that they're placing, and trying to not outsmart them, but be cognizant and work actively in order to get ahead of them. They, of course, lead to the 32 sources of failure. Bit of a plug here, but we've gone through the sources of failure here, a little bit of a high level. I encourage you to dive deep into the strategy sources of strategy failure. Get your copy of the book. You can download it digitally. If you want, you can write a mail to jbe@fadrant.dk, and if you put in your postal address, we will send you a physical copy. We have printed versions coming. Or you can swing by to the office as well and get your copy once they arrive. So feel free to write to them.